Welcome back. Let's explore the foundational structure of insurance regulation in Georgia by focusing on the core authority governing the marketplace. The insurance industry in Georgia is overseen by a specific executive branch official known as the Georgia Insurance and Safety Fire Commissioner. This position is a constitutionally mandated office, meaning the leader is chosen directly by the citizens of Georgia during statewide general elections. The individual who wins this election serves a 4-year term, running concurrently with the state's gubernatorial cycle. To qualify for this office, a candidate must meet specific statutory requirements, including being at least 25 years old and having a history of United States citizenship for a decade, alongside maintaining residency within Georgia for at least 4 years prior to taking office. There are no limits on the number of terms a commissioner may serve, allowing for potential long-term consistency in leadership across consecutive administrations. By creating an elected executive position, the state designees ensure that the regulator remains directly accountable to the public rather than serving at the pleasure of the governor or an appointed board. The primary mandate of the commissioner is to execute and enforce the provisions of the Georgia Insurance Code, a task managed through the Office of Insurance and Safety Fire Commissioner, often abbreviated as the OCI. It is vital to understand that the commissioner does not enact insurance laws, as that authority belongs solely to the state legislature. Instead, the commissioner possesses broad administrative powers to create rules and regulations that clarify and implement existing statutes. This dynamic ensures that while the legislative body sets policy, the executive branch maintains the practical machinery to govern market conduct and protect consumers from unfair practices. To fulfill this mandate, the OCI operates as a robust regulatory framework, monitoring the financial stability and market behaviors of all insurance organizations transacting business inside the state. The authority of the office extends across several operational divisions, ensuring that policyholders encounter a fair, competitive, and solvent marketplace when buying coverage. A central aspect of this oversight involves managing both domestic and foreign insurance corporations. A domestic insurer is a company formed under the laws of Georgia, whereas a foreign insurer is formed under the laws of another United States jurisdiction or territory. The commissioner holds the administrative power to issue, renew, suspend, or revoke the certificate of authority, which serves as the formal state license required for any company to legally sell insurance policies in Georgia. Before granting this certificate, the OCI reviews financial statements, corporate charters, and management backgrounds to verify that the entity can fulfill its future promises to policyholders. If an insurer, whether domestic or foreign, fails to maintain adequate financial reserves or engages in deceptive market conduct, the commissioner can strip away this certificate. This licensing mechanism acts as a primary gatekeeper, ensuring that only viable and compliant entities operate within state borders. To ensure ongoing compliance with state laws, the commissioner is granted broad investigative powers to examine the financial condition and operational practices of licensed entities. State statutes require that the commissioner or a designated examiner inspect the books, records, and accounts of every domestic insurer at least once every 5 years. This examination schedule is a minimum standard, and the commissioner retains the unilateral right to conduct an unannounced investigation or audit at any moment if consumer complaints or financial red flags suggest a problem exists. Foreign insurers operating in Georgia are typically subject to similar examinations, though the commissioner may accept an audit report from the insurer's home state regulator if that department follows comparable regulatory standards. The expenses incurred during these thorough corporate examinations are billed directly to the insurance company being audited, protecting state taxpayers from bearing the financial burden of industry oversight. When investigations reveal potential statutory violations or unsafe financial practices, the commissioner has the administrative authority to issue formal cease and desist orders or convene official hearings. Before any disciplinary action becomes permanent, The commissioner must provide written notice to the affected party, stating the specific charges and scheduling a formal administrative hearing. This process satisfies constitutional due process requirements, offering the insurer or producer an opportunity to present evidence, cross-examine witnesses, and argue their case before an administrative judge or the commissioner. If the hearing validates the initial findings of noncompliance, the commissioner can impose strict administrative penalties to deter future violations. These penalties frequently include the imposition of substantial monetary fines, which can range from thousands of dollars per violation up to even greater sums if the deceptive practices are proven to be intentional or widespread. Beyond corporate oversight, the commissioner directly regulates the marketplace professionals known as producers, agents, and brokers. The OCI establishes the educational and ethical benchmarks that individuals must satisfy before they can legally solicit, negotiate, or sell life insurance products to the public. By controlling the producer licensing pipeline, the commissioner ensures that consumers interact with knowledgeable, ethical professionals who understand the complexities of life insurance contracts. The commissioner possesses the authority to suspend or revoke an individual producer's license if that agent engages in fraud, misrepresentation, or any unfair trade practices that harm the public interest. Through this combined oversight of corporate entities and individual market participants, the Office of Insurance and Safety Fire Commissioner maintains the delicate balance required to foster a healthy insurance economy while protecting vulnerable consumers from financial exploitation. See you in the next lecture. Hello, and welcome back. When we look at the regulatory landscape governing insurance companies, we're looking at the foundational architecture that makes our entire industry viable. If anyone could simply print a policy form, collect premium payments, and promise a payout 40 years into the future without oversight, the system would collapse under the weight of human insolvency and bad faith. To prevent this, the state of Georgia implements a strict framework of structural boundaries designed to ensure that every risk bearer operating within its borders is legitimate, solvent, and fair. As an aspiring professional, understanding these baseline rules is not just a matter of passing an exam. It is about grasping how state authority structurally enforces consumer protection. We will walk through the specific classifications that the Georgia Department of Insurance assigns to risk entities based on where they were formed, what documents they must possess to legally operate, and how their products are monitored. The first concept we must model is the geographic categorization of insurers, which is based entirely on where the company's corporate charter was filed. A domestic insurer is an insurance company that is formed and incorporated under the explicit laws of the state of Georgia. When you see a company with its corporate headquarters and original charter registered in Atlanta or Savannah, that entity is operating as a domestic insurer within this state. A foreign insurer, by contrast, is formed under the laws of any other state or government within the United States, such as an entity incorporated in Ohio or Delaware, but doing business here. Finally, an alien insurer is an entity formed under the laws of a completely different country outside the United States, such as a risk bearer incorporated in Canada, Germany, or Switzerland. It is a common point of confusion to think that foreign means outside the country, but in legal terms, another U.S. state is considered a foreign jurisdiction. Regardless of whether an insurance company is categorized as domestic, foreign, or alien, it cannot simply open its doors and begin selling policies to Georgia residents without explicit state permission. This permission manifests as a legal document known as a certificate of authority, which officially classifies the company as an authorized or admitted insurer. To obtain and maintain this certificate, an entity must submit to the comprehensive regulatory oversight of the Georgia Insurance Commissioner. Operating without this certificate transforms the company into an unauthorized or non-admitted insurer, making its activities illegal and exposing anyone involved to severe administrative and criminal penalties. The process of authorization acts as a gateway filter, ensuring that only businesses willing to comply with Georgia's operational mandates can step into the marketplace. It represents the state's baseline mechanism for separating stable risk managers from volatile or predatory operators. Once an insurer passes through that regulatory gateway, it must continuously prove that it possesses the financial capacity to back up the long-term promises it makes to consumers. Georgia law enforces strict capital and surplus requirements to ensure robust financial solvency, meaning the company must always hold a specific cushion of assets above its liabilities to absorb unexpected loss spikes. For instance, a newly formed domestic stock life insurance entity in Georgia must maintain specific baseline levels of paid-in capital and clear surplus funds to operate legally. The Commissioner actively verifies this financial posture by demanding regular access to the company's internal books and records for detailed administrative oversight. State examiners possess the legal authority to audit these accounts, ensuring that the company's financial reporting is completely transparent and free from deceptive accounting metrics. If an audit reveals that a company's capital has become impaired, the state can intervene immediately to protect policyholders from a sudden corporate collapse. The state's protective boundary extends directly into the actual policy contracts and pricing structures that companies present to the public. Insurance companies are mandated by Georgia law to submit all of their rate plans and policy forms to the Office of the Insurance Commissioner for review and approval prior to utilizing them in the market. The Commissioner examines these rate filings with a highly specific analytical lens, evaluating the math to ensure that prices are adequate, not excessive, and not unfairly discriminatory. A rate is considered excessive if it generates unreasonably high profits at the expense of captive consumers, while is unfairly discriminatory if it charges different premiums to individuals with the exact same risk profile. Through this system of administrative review, the state prevents companies from leveraging complex actuarial language to overcharge the public or destabilize the market through predatory pricing models. See you in the next lecture. Hello, and welcome back. We are here to establish a precise understanding of the statutory framework underpinning insurance transactions in our jurisdiction. Today, we need to focus on how the state architecture governs your daily operations, specifically examining the explicit boundary between the formal statutes enacted by the legislature and the administrative execution managed by the regulator. To understand your obligations as a licensed producer, you must first recognize the structure of authority established by the Georgia Insurance Code, which is codified under Title 33 of the Official Code of Georgia Annotated. The legislature creates the statutory boundaries, but it delegates the practical enforcement and operational rulemaking to the Insurance Commissioner. When the Commissioner adopts administrative rules and regulations, these mandates carry the full force and effect of law, meaning they are not optional guidelines or mere recommendations. They represent binding legal requirements that dictate exactly how you must conduct your business, manage your client interactions, and maintain your professional standing. Every rule issued under this authority is designed to interpret and implement the broad strokes of the statutes, filling in the technical details necessary to keep the marketplace stable and fair. Among these administrative mandates, record-keeping practices stand out as a foundational requirement that you cannot afford to overlook. The state enforces strict record-keeping protocols to ensure that every transaction leaves a clear, verifiable trail for auditors. You are required to maintain complete and accurate records of all insurance policies you write, including applications, premium collections, and correspondence, for a minimum specified period. These records must be readily accessible for inspection by the Department of Insurance at any time, acting as a crucial mechanism for consumer protection and regulatory oversight. Failing to preserve these documents or presenting disorganized, incomplete files during an investigation is treated as a direct violation of administrative law. It is your personal responsibility as a producer to implement robust systems that guarantee the integrity and permanence of these records. Another critical administrative obligation is the strict requirement to report any significant changes to your professional profile within a fixed window. Specifically, you must notify the Commissioner's office of any change in your legal name, business address, or residence address within 30 days of the modification. The department uses this timeline to maintain an accurate roster of licensees and ensure that official legal notices can always be delivered reliably. This 30-day reporting window is a strict statutory deadline, leaving no room for administrative oversight or casual delays. If you relocate your office or change your surname through marriage and fail to submit the proper documentation within those 30 days, you are in immediate noncompliance. The state views an outdated roster as a serious threat to regulatory efficiency, and they track compliance with this rule quite aggressively. We must also look at how these insurance-specific administrative codes intersect with broader consumer protection frameworks, most notably the Georgia Fair Business Practices Act. While the Fair Business Practices Act is the state's primary weapon against deceptive trade practices in general commerce, the unique nature of the insurance industry means it is governed primarily by its own set of laws within Title 33. The intersection of these frameworks ensures that ethical conduct remains absolute, as the specific unfair trade practice regulations inside the insurance code are designed to mirror the consumer-first philosophy of the broader act. This means that any attempt to mislead a consumer, falsify policy terms, or engage in deceptive marketing is simultaneously a violation of your professional licensing rules and the broader public interest. The legal framework operates seamlessly to ensure that producers who engage in predatory or dishonest behaviors cannot hide behind regulatory loopholes. When a producer fails to adhere to these administrative codes, the legal consequences of noncompliance are severe, swift, and clearly defined. The Commissioner possesses the explicit statutory power to impose hefty administrative fines, suspend your license for a designated period, or revoke your authorization to transact insurance permanently. A suspension serves as a temporary halt to your livelihood, while a revocation often acts as a permanent ban from working within the financial services sector of the state. These disciplinary actions are public record and can permanently damage your professional reputation across the entire country. Adhering to the administrative procedures is not about avoiding minor inconveniences. It is about preserving your legal right to practice your profession. See you in the next lecture. Welcome back. Let's look closely at how the state ensures compliance when rules are not followed. The Georgia Insurance Department maintains a structured framework for conducting investigations and administrative hearings to oversee the market. At the center of this framework is the absolute authority of the insurance commissioner to examine the operational affairs of both insurance companies and individual producers. This regulatory mechanism is not an optional check, but a legally mandated inspection power that allows the department to review all books, records, documents, and corporate accounts without requiring a prior judicial warrant. Under Georgia law, domestic insurers must submit to a comprehensive examination of their financial condition and compliance protocols at least once every 5 years, though the Commissioner reserves the statutory right to initiate an unannounced investigation at any given moment if a violation or financial instability is suspected. For an individual producer, this means that any transaction log, premium account record, or consumer correspondence must be organized and available for state inspection immediately upon official request. When an investigation uncovers anomalies or potential violations of the Georgia Insurance Code, the department cannot summarily strip a licensee of their professional credentials without respecting due process. Due process is a constitutional and administrative protection designed to guarantee that any licensee facing disciplinary action receives formal notice of the allegations and a legitimate opportunity to present a legal defense. Before any public administrative hearing can take place, the department must issue a formal notice of hearing directly to the affected party. Georgia administrative rules dictate that this written notice must be served to the licensee at least 10 days prior to the scheduled hearing date, ensuring they have sufficient time to retain legal counsel, review the specific statutory charges, and gather evidentiary documentation. The notice must explicitly state the exact time, the physical or virtual location of the proceedings, the specific legal authority under which the session is convened, and a clear statement of the factual matters at issue. The formal public hearing operates in a manner highly similar to a civil bench trial, with the enforcement section of the insurance department stepping in to represent the commissioner. Attorneys from the enforcement section assume the prosecutorial role, presenting evidence, calling witnesses under oath, and submitting formal examination reports to substantiate the alleged violations. Despite the structured nature of these proceedings, Georgia law explicitly states that the technical and rigid rules of pleading or evidence used in standard criminal trials do not strictly apply to these administrative hearings. This deliberate flexibility allows the hearing officer to evaluate a wider spectrum of relevant documentation, though the core standard of fairness remains intact. The licensee enjoys full reciprocal rights during this process, meaning you have the absolute right to appear in person, be represented by a qualified attorney, cross-examine state witnesses, present your own documents, and request the issuance of subpoenas to compel witness testimony. Once the hearing concludes, the administrative process transitions into the final adjudication phase, where the legal consequences of verified violations are formally determined. The commissioner or the appointed administrative judge reviews the complete record of the proceedings and issues a binding final order containing written findings of fact and conclusions of law. If the evidence supports the conclusion that a violation occurred, the resulting administrative penalties can be severe and financially damaging. The commissioner possesses the legal authority to issue a cease and desist order to halt non-compliant practices immediately, levy administrative monetary fines that can reach up to $2,000 per willful violation, or place the producer on probation. In scenarios involving systemic fraud, misrepresentation, or severe ethical failures, the final administrative order may result in the complete suspension or permanent revocation of the individual's producer license, effectively ending their insurance career in the state. See you in the next lecture. Hello and welcome back. We are shifting our focus today to the concrete mechanics of entering and participating in the state insurance market as a professional. Specifically, we will look at how an individual legally establishes and sustains the status of a resident producer within the state of Georgia. Navigating this environment requires an exact understanding of chronological windows, biological milestones, and specific administrative protocols. Our objective here is to break down these statutory operational thresholds into a clear, predictable framework so that you can see exactly how the state regulates access to the market. Let us begin by analyzing what it takes to secure an initial resident license from the ground up. To establish eligibility for a resident producer license in Georgia, an applicant must first satisfy specific statutory baselines. The legal system dictates that you must be at least 18 years of age and maintain a primary residence or a principal place of business within the boundaries of the state. Assuming these preliminary criteria are met, the next structural milestone is the completion of a state-approved pre-licensing education course. The regulatory architecture demands a minimum of 8 hours of formal instruction for a single line of authority, such as life insurance, or 16 hours for a combined line, which must be executed through an authorized education provider. Once you successfully navigate this course and receive a certificate of completion, that document remains legally valid for exactly 12 months from its date of issuance. If you do not leverage that certificate to complete the next phases of the process within that year-long window, the credit expires completely, requiring you to repeat the entire course of study. With the educational prerequisite satisfied, the next logical step in the sequence is to challenge and pass the official state licensing examination. Georgia uses an independent testing vendor, Pearson VUE, to administer these assessments at physical testing centers under strict proctoring conditions. A passing score of 70% is required to validate your technical competence in both general insurance principles and Georgia-specific statutory laws. Just like the pre-licensing education certificate, your passing examination score comes with a strict expiration date, meaning you must formally apply for your producer license within 12 months of passing the test. If you miss this deadline, the state considers the examination results void, forcing you to retake the entire exam. Furthermore, candidates who happen to fail the test are subject to statutory waiting periods before they can schedule a retest, specifically a 14-day cooling-off period after the first and second attempts, which expands to a 60-day waiting period after a third consecutive failure. The final component of the initial application process involves verifying the applicant's background and personal integrity through a formal screening mechanism. Georgia requires all new resident applicants to submit their fingerprints electronically through an authorized statewide vendor, such as IdentoGO, to facilitate a comprehensive criminal background check. This biometric data is routed directly to the Georgia Bureau of Investigation and the Federal Bureau of Investigation to ensure the candidate possesses a trustworthy professional background. Alongside these fingerprints, you must submit a completed resident insurance license application through an approved online portal like CIRCON or the National Insurance Producer Registry. This package must include a notarized citizenship affidavit form, which legally verifies your lawful presence and right to work within the United States. Only after the Department of Insurance confirms the receipt and validity of the fingerprints, the affidavit, the educational credits, and the passing exam score will a license actually be issued. Once a resident producer license is successfully obtained, the operational focus shifts entirely to the mechanics of license maintenance and its associated chronological cycles. A Georgia producer license does not remain active indefinitely. Instead, it operates on a strict 2-year renewal cycle based entirely on the licensee's birth month. Specifically, your license is engineered to expire biennially on the final day of your birth month, alternating based on the year your license was initially granted. The state establishes an active renewal window that opens exactly 90 days prior to this expiration date, giving you an adequate operational buffer to complete all administrative requirements. To execute a standard renewal, a producer must submit the appropriate electronic renewal application, pay the baseline state renewal fee, and verify the successful completion of all mandatory continuing education hours. If you fail to submit this documentation before the clock strikes midnight on the final day of your birth month, your license immediately slips out of active status. To account for unexpected administrative friction or human error, Georgia statutory law provides a brief late renewal window immediately following the official expiration date. This mechanism takes the form of a 15-day late renewal period, during which an expired license can still be saved without completely losing its structural standing. If a producer completes their continuing education and files their renewal application within this 15-day grace period, the state allows the license to be renewed upon the payment of an additional $15 late fee on top of the standard renewal costs. However, it is a significant mistake to view this grace period as a casual extension of your ability to conduct business. During those 15 days, your license is technically considered inactive, meaning you cannot legally solicit, negotiate, or execute new insurance contracts until the late renewal is completely processed and officially approved by the state. When a producer completely misses the 15-day late renewal window, the license enters a formal state of inactivation, terminating standard renewal eligibility. At this juncture, the administrative path forward shifts from a simple renewal to a comprehensive reinstatement process, which remains available for exactly 12 months from the original expiration date. To successfully reinstate an inactive license within this 1-year time frame, An applicant must submit a dedicated reinstatement application exclusively through the CIRCON portal and pay a substantial financial penalty. The state levies a $150 reinstatement penalty in addition to the standard licensing fees, reflecting the increased administrative burden of processing a delinquent file. Furthermore, if a license has remained in an inactive state for more than 6 months of that year-long window, the producer must submit a completely new set of electronic fingerprints for an updated background check. If the full 12-month reinstatement window lapses without action, the license is permanently canceled, meaning the individual must start over completely as a brand new applicant. There are specific circumstances where the state pauses these rigid renewal timelines, particularly to accommodate individuals who are called into active military service. If a licensed resident producer is deployed or placed on active duty, Georgia law provides a mechanism to transition a license into a protected inactive status for military duty. This administrative designation effectively freezes the producer's licensing requirements, exempting them from standard renewal fees and continuing education obligations for the entire duration of their active service. To secure this protection, the producer or an authorized representative must formally submit a request along with official copies of their military deployment orders to the Department of Insurance. When the period of active duty concludes, the individual can safely request the removal of the non-active status without facing any late penalties, retroactive fees, or loss of licensure standing. This accommodation ensures that service members are not professionalized penalized for their absence, provided they keep their administrative records properly aligned with the state's protocols. See you in the next lecture. Hello. Expanding an insurance practice beyond the borders of your home state requires an understanding of how distinct legal jurisdictions interact. The state of Georgia governs this interaction through formal reciprocity agreements, allowing individuals who hold a resident license in another state to obtain a Georgia non-resident license. This mechanism relies entirely on the status of your home state license, which must be active and in good standing. If your home state recognizes Georgia residents on a similar basis, the bureaucratic friction is significantly reduced. The application process is streamlined because the state waives the standard pre-licensing education and examination requirements that resident applicants must endure. Instead of retaking a high-stakes exam, you submit the proper administrative request and pay the required fees to the Office of the Commissioner of Insurance. While the insurance requirements are simplified, non-resident licensees remain strictly bound by Georgia's regulatory framework once the license is issued. This means you cannot legally act as an agent for an insurance company in Georgia until you are formally appointed by that specific insurer. The insurance company must file a notice of appointment within 15 days from either the date the license is granted or the date the first insurance application is submitted. Furthermore, maintaining this license requires diligence regarding your physical and legal location. If you relocate your primary residence or business address, Georgia law mandates that you notify the commissioner of the change within 30 days. This rule ensures that the regulatory database remains accurate, and failing to comply can result in administrative fines or license complications. A completely different regulatory mechanism exists for temporary producer licenses, which serve a highly specialized and restrictive purpose. Temporary licenses are designed for short-term operational continuity, often triggered by emergency succession planning, such as the death, disability, or military deployment of a licensed producer. They can also be issued for the purpose of training an individual under close supervision. To prevent abuse of this privilege, Georgia law dictates that a temporary license is a once-in-a-lifetime issuance per line of authority. You cannot chain multiple temporary licenses together or use them as a permanent alternative to passing the state exam. The initial duration is strictly capped at 6 months, though the commissioner retains the discretionary power to renew it in 3-month increments if the situation warrants. An applicant for a temporary license does not need to sit for the state licensing exam or complete the standard resident pre-licensing coursework. However, the law compensates for this lack of examination by requiring strict corporate sponsorship and operational boundaries. An authorized insurance company must formally sponsor the applicant, and a fully licensed and appointed agent must directly supervise all activities. The legal duties a temporary licensee can perform are purposefully restricted to maintaining existing business operations. You are legally authorized to negotiate policy renewals, collect premiums, and perform administrative acts necessary to keep the current book of business intact. Crucially, a temporary license does not grant the authority to sell, solicit, or negotiate entirely new insurance accounts. See you in the next lecture. Hello and welcome back. When we design software systems, we rely on encapsulation to ensure that components behave predictably according to their stated contracts. And a similar principle applies to the legal framework of the Georgia insurance marketplace. In this domain, predictability and consumer trust are maintained by strictly enforcing boundaries against deceptive behaviors, a concept codified in state law under the umbrella of unfair trade practices. The Georgia Insurance Code explicitly details the boundaries of acceptable marketplace behavior to prevent consumer harm, maintain market transparency, and ensure that individuals can make decisions based on clear, unvarnished information. As a future producer, your understanding of these boundaries is not merely an exercise in compliance, but a fundamental requirement for operating with professional integrity. In this discussion, we will dissect the specific legal definitions of prohibited actions, look at how the law characterizes deceptive marketing materials, and examine the serious legal consequences that follow any breach of these standards. Misrepresentation is the first major boundary violation we must examine, and it occurs when a producer or insurer makes false or misleading statements regarding the true nature of an insurance policy. Under Georgia law, this includes any estimate, illustration, circular, or statement that distorts the terms of any policy issued or to be issued, the benefits or advantages promised, or the dividends to be received. If you tell a prospective client that a policy guarantees a specific return on cash value when it does not, or if you misstate the conditions under which benefits are paid, you have committed misrepresentation. The law explicitly targets marketing materials or verbal assertions that lead to confusion regarding premium costs or policy benefits, meaning that ambiguity designed to obscure real costs is treated with the same severity as an outright lie. It is your responsibility to present every policy as it is written, without exaggeration or omission, ensuring the consumer sees a precise architectural blueprint of their coverage rather than a decorated sales pitch. Closely aligned with misrepresentation is the practice of false advertising, which expands the scope of deception from individual conversations to the broader public sphere. Georgia state law prohibits any person or entity from publishing, disseminating, circulating, or placing before the public any advertisement, announcement, or statement that is untrue, deceptive, or misleading. This restriction encompasses newspapers, magazines, radio broadcasts, television commercials, internet marketing, pamphlets, letters, and posters. A common manifestation of this infraction involves issuing marketing materials that present a distorted view of an insurance company's financial strength or competitive position. For example, creating a brochure that falsely suggests an insurer holds a higher financial rating than it actually does violates the law because it manufactures a false sense of security. The regulatory framework demands absolute transparency in all public-facing materials, forcing companies to compete strictly on the verified merits of their financial stability and product design. Defamation represents a different kind of marketplace disruption, focusing not on inflating one's own standing, but on maliciously tearing down a competitor to gain an unfair advantage. In Georgia, defamation is defined as making, publishing, or circulating any oral or written statement, or any pamphlet, circular, article, or literature, which is false or maliciously critical of or derogatory to the financial condition of an insurer. If a producer tells a prospective client that a competing insurance company is on the verge of bankruptcy when there is no factual basis for that claim, that producer has crossed the legal line into defamation. This regulation is designed to protect the stability of the entire insurance system, as false rumors can trigger panic and erode public confidence in valid institutions. The law requires that any comparison you make between insurers or policies must be grounded in verified, objective facts rather than malicious speculation or derogatory characterizations. When these deceptive marketing practices cross the threshold into intentional deception for financial gain, the legal framework treats the behavior as insurance fraud. In Georgia, fraud is not handled as a minor administrative oversight. It is defined as a serious crime that carries heavy statutory penalties. Any natural person who knowingly and willfully makes or aids in making a false or fraudulent statement of a material fact on a policy application or in a written statement commits fraud. When a producer uses deceptive marketing materials to intentionally manipulate an applicant into purchasing a policy under false pretenses, they're exposing themselves to criminal liability. Under the Georgia Insurance Code, a conviction for felony insurance fraud carries a penalty of imprisonment for a period of not less than 2 years and not more than 10 years, or a criminal fine of up to $10,000, or both. Additionally, the insurance commissioner has the administrative authority to levy substantial civil penalties, revoke professional licenses, and issue cease and desist orders against any individual violating these provisions. See you in the next lecture. Hello and welcome back. When you look at how insurance policies are constructed, the premium is mathematically tied to the risk profile of the insured. Georgia law treats this relationship with absolute rigidity to maintain market stability and prevent arbitrary discrimination. In this context, rebating is defined as the unlawful practice of offering, paying, or allowing any financial benefit or consideration that is not explicitly specified in the written policy document as an incentive to purchase insurance. This means you cannot alter the cost of entry for a consumer by introducing outside financial variables to sweeten the deal. Both the giving and the receiving of a rebate are prohibited under the Georgia Insurance Code because doing so undermines the underlying rate filings that keep the industry solvent. For the state licensing exam, you must recognize that any side agreement affecting the policy's economic value constitutes a direct violation. Illegal inducements represent a broader category of forbidden transactional incentives that extend beyond simple premium alterations. An illegal inducement occurs when a producer offers personal property, special favors, stock options, or promises of employment to a prospective client to secure their business. Under Georgia law, you cannot promise a prospective client a position on an advisory board or offer them discounted services from a separate business you own. There are very strict statutory boundaries regarding what can be given to a consumer during a promotional sequence. Currently, Georgia law allows producers to host sales presentations and provide modest food and refreshments, provided no applications are executed during the presentation. Furthermore, advertising programs can distribute promotional merchandise or gift cards, but these items cannot exceed a total aggregate value of $100 per customer in any single calendar year. The legal reasoning behind these strict statutory prohibitions is anchored fundamentally in market fairness and consumer protection. If insurance producers were allowed to compete by cutting their own commissions or giving away expensive material goods, the largest agencies would quickly monopolize the market. This scenario would systematically eliminate independent producers who cannot afford to match those financial concessions, drastically reducing consumer choice over time. Additionally, rebating introduces unfair discrimination because it allows two individuals with the exact same risk profile to pay completely different effective rates for identical coverage based entirely on their negotiation skills. The state intervenes in these transactions to ensure that pricing remains transparent, competitive, and completely detached from arbitrary transactional leverage. By standardizing the actual cost of a policy for every consumer within a specific risk class, the regulation preserves the financial integrity of the overall insurance ecosystem. To successfully identify these practices on the exam, you must evaluate scenario-based questions against the absolute letter of the written contract. Consider a situation where a producer offers to return 25% of their first-year commission to a client who agrees to purchase a large life insurance policy. Because this commission kickback is an economic benefit not documented within the contract, it is a textbook example of rebating. Another scenario might involve a producer offering to buy an expensive set of golf clubs for an executive who is considering a group life insurance plan for their corporation. This offer constitutes an illegal inducement because it introduces a high-value physical asset into the transaction as a purchasing leverage mechanism. You must remember that even subtle actions, such as offering an interest-free loan to cover the initial premium payment, violate these trade practices because they introduce an unwritten financial advantage. See you in the next lecture. Welcome back to our exploration of insurance regulations in Georgia. Today, we are focusing on a critical aspect of professional conduct within the industry, the prohibition of coercive and intimidating tactics. In the context of insurance sales, coercion and intimidation are categorized as unfair trade practices that fundamentally undermine the principles of fair competition. When we talk about coercion, we are referring to any act that uses physical or mental force to pressure an applicant into purchasing a policy. This is not merely a breach of professional etiquette, but a direct violation of state law, as codified in the Georgia statutes governing unfair methods of competition. The law is designed to prevent scenarios where an insurance producer or entity leverages power or threats to restrict the free choice of a consumer. By creating an environment where an individual feels they have no reasonable alternative but to comply with a demand, the actor is engaging in conduct that effectively restrains trade. Such behavior is strictly prohibited because it corrupts the voluntary nature of the insurance contract and can lead to the formation of monopolies in the marketplace. To identify these prohibited actions, one must consider whether an agreement to commit or any concerted action results in, or tends to result in, the unreasonable restraint of the business of insurance. Intimidation often manifests as a form of hard sell that crosses the line into illegal territory, such as threatening an applicant's livelihood, property, or safety to secure a signature on an application. These tactics are antithetical to the ethical standards imposed on licensed producers, who are expected to act in the best interests of the consumer. An applicant has a fundamental legal right to refuse coverage or choose a provider based on their own assessment of their needs, without fear of repercussions. When an agent or insurer attempts to override this autonomy through fear or aggressive pressure, they're violating the very framework that regulates the industry. It is therefore incumbent upon every producer to recognize that any communication or action that compromises a prospect's ability to make a free, informed decision is legally perilous. The consequences for engaging in such illicit behavior are severe and serve as a strong deterrent to maintain industry integrity. Under Georgia law, the Commissioner of Insurance is empowered to investigate allegations of coercion and intimidation, and those found in violation can face significant administrative penalties. These may include the suspension or revocation of a producer's license, which effectively terminates their ability to conduct business in the state. Beyond the loss of licensure, the state may impose substantial monetary fines for each act of prohibited conduct, and the individual may face further disciplinary actions that follow them throughout their career. Legal remedies available to injured parties may also involve civil litigation, where an applicant could sue for damages caused by the coercive practices. Because these penalties are intended to protect the public, the department takes a hard stance against any producer who substitutes influence for integrity. Protecting the consumer from such pressure is a cornerstone of regulatory oversight and remains a primary objective of the state's compliance requirements. Understanding these boundaries is essential for any professional navigating the Georgia insurance landscape. Always ensure that your sales process is built on transparency, education, and a genuine alignment of products with a client's actual needs rather than external pressure. By adhering to these ethical standards, you not only protect yourself from the risk of administrative sanctions, but also contribute to the overall health and reputation of the insurance industry. Professionalism in this field is defined by the ability to guide clients toward informed decisions without resorting to manipulation. Keep these legal parameters in mind as you conduct your day-to-day operations and interact with your client base. I will see you in our next session. Coercion in insurance. Life insurance exam prep. This video is relevant because it provides a concise breakdown of the definition of coercion in insurance and highlights why understanding these specific unfair trade practices is vital for your exam success. Welcome back. When you obtain an insurance license, the state expects you to operate a viable commercial enterprise that serves the general public. To prevent individuals from leveraging a license merely to capture commissions on risks they already control, Georgia enforces strict controlled business regulations. Controlled business is legally defined as any insurance coverage written on a producer's own life, health, or property, or that of their immediate family members and business associates. The underlying policy concern is straightforward. The state wants to prevent the distortion of the insurance market that occurs when a license is used primarily as a vehicle for self-dealing or internal discount capture. If you write a policy for your spouse, your sibling, or your corporate partner, you are engaging in control business, and that volume is subject to statutory caps. Georgia law establishes a hard ceiling on this practice, dictating that no more than 25% of a producer's total volume can be derived from control business in any given calendar year. This percentage is measured against your total aggregate volume, meaning that at least 75% of your written premiums must originate from independent, arm's-length transactions with the public. It is a severe regulatory violation to obtain or maintain an insurance license for the sole purpose of writing control business. To ensure compliance, producers must keep meticulously documented sales ratios that prove they meet these thresholds. The state monitors these balances closely through periodic reporting requirements and audits, and failing to maintain the correct distribution of business can result in immediate disciplinary action against your license. See you in the next lecture. Welcome back. When we design systems, we must establish constraints that protect the system from corruption. In the realm of insurance transactions, the state of Georgia establishes these constraints through a comprehensive framework designed to protect the individual buyer. While the insurance commissioner heavily regulates the technical and financial aspects of policies, broader commercial transactions are subject to overarching legislative measures. The foundational pillar of this external oversight is the Fair Business Practices Act. This specific piece of legislation establishes the ground rules for how commerce operates within the state boundaries. It explicitly governs consumer transactions, which encompasses the sale, lease, or marketing of products and services intended primarily for personal, family, or household purposes. As an insurance producer, your daily operations fall squarely within this definition, meaning your marketing, solicitations, and customer interactions are bound by these statutory requirements. A core objective of the Fair Business Practices Act is the absolute elimination of deceptive market behaviors that undermine a consumer's ability to make rational choices. One of the most prevalent systemic failures targeted by this law is the bait-and-switch tactic. In a typical bait-and-switch scenario, a business advertises a highly attractive, low-cost product or premium rate with the hidden intention of never actually selling that specific item. Once the consumer is engaged, the seller disparages the advertised option or claims it is unavailable, subsequently steering the consumer toward a much more expensive alternative. The law interprets this as an intentional distortion of marketplace data. When you solicit insurance in Georgia, every rate, benefit, and policy provision you present must reflect an authentic product that is genuinely available to the applicant under the specified conditions. Advertising a low-cost framework merely to capture a lead, while planning to pivot to a higher premium plan, constitutes a direct statutory violation. The prohibition against false advertising extends far beyond simple product availability to include specific misrepresentations regarding sale prices, discounts, and product quality. The statute clarifies that it is entirely unlawful to make misleading statements concerning the reasons for or the existence of price reductions. For instance, an agent cannot claim that a particular life insurance premium rate is a special, one-time only markdown when, in reality, that rate is the standard baseline cost for any consumer of similar risk profile. Furthermore, presenting a low-quality or highly restricted policy as a premium, comprehensive coverage package breaches the mandate for quality transparency. The law demands that the structural attributes of the asset being sold match the verbal and written descriptions provided during the solicitation process. Distorting these metrics creates a false economy and strips the consumer of their agency, which is exactly what the state framework is engineered to prevent. Telemarketing fraud represents another critical vector of deceptive conduct explicitly curtailed by Georgia law. The Fair Business Practices Act contains specialized, stringent provisions that govern telephone solicitations to protect citizens from intrusive and fraudulent sales strategies. When executing telephone outreach, insurance producers must adhere to strict guidelines regarding disclosure, consent, and truthfulness. It is illegal to use automated dialing systems or manual cold calling to transmit misleading information regarding the identity of the insurance agency or the nature of the call. Misrepresenting a sales pitch as a government survey, a courtesy check, or a non-commercial notification is a severe breach of these telemarketing regulations. Every telephonic point of contact must immediately and transparently establish that the purpose of the call is the solicitation of an insurance product. Failing to do so invites heavy administrative and civil penalties. Enforcement of these broad consumer protection mandates falls under a distinct governmental jurisdiction separate from the Department of Insurance. The primary entity tasked with monitoring the marketplace and litigating systemic commercial fraud is the Attorney General's Consumer Protection Division. This specialized division acts as an enforcement mechanism for the entire state, stepping in to investigate and prosecute patterns of deceptive conduct. However, the Consumer Protection Division does not typically intervene to resolve isolated, private contractual disputes between two parties. Instead, the statute explicitly directs the Attorney General to pursue legal actions and enforce penalties whenever there is a demonstrated substantial public interest. This means that if an insurance producer or an entire agency utilizes systemic false advertising or widespread bait-and-switch operations that threaten the general public, the Attorney General will deploy the full force of the state's legal apparatus to halt the behavior. Understanding these external mandates is vital because they establish the baseline standard of care and honesty expected of every insurance producer in Georgia. Compliance with state law is not a matter of avoiding explicit insurance code violations alone. It requires total alignment with the state's broader commercial ethics. The law explicitly mandates that consumer interests must remain the top priority throughout the life cycle of any transaction. Every presentation, policy comparison, and telephone call must be executed with a degree of transparent honesty that allows the buyer to clearly see the true costs and benefits of the asset. When you maintain this level of precision and integrity, you remain completely insulated from both the disciplinary actions of the insurance commissioner and the consumer protection lawsuits orchestrated by the state attorney general. See you in the next lecture. Welcome back. When we analyze state insurance regulations, We are examining a system designed to mitigate information asymmetry between an industry expert and a consumer. In the context of active duty military personnel, Georgia law introduces an explicit overlay of compliance requirements to prevent predatory sales practices. This regulatory structure acknowledges that service members represent a unique demographic exposed to specific operational realities and financial structures. As a producer, you cannot treat a solicitation to an active duty service member in pay grades E4 and below with the same assumptions you might apply to a civilian corporate employee. The state demands a higher standard of care, structured disclosures, and absolute transparency regarding the product type and the intent of your interaction. A significant point of failure in compliance involves the misrepresentation of a producer's role or identity. Georgia insurance regulations explicitly declare it a deceptive trade practice to utilize misleading titles or designations that imply an official relationship with the government or the military. For instance, you are prohibited from using titles such as Veterans Benefits Counselor, Military Advisor, or Army Benefits Consultant during a solicitation. These titles have the operational effect of masking your true commercial function, which is the sale of an insurance product. The law requires that you remain explicit about your status as an independent insurance producer representing a specific authorized insurer. The rule extends from personal titles to the actual materials used to generate leads or establish appointments. You cannot deploy lead-generating marketing pieces designed exclusively for service members unless those materials clearly and conspicuously disclose that the recipient will be contacted by an insurance producer for the purpose of soliciting life insurance. Furthermore, when you establish a specific appointment for an in-person, face-to-face meeting, you must explicitly disclose beforehand that the meeting will involve a solicitation for the sale of life insurance. Failing to declare the true commercial nature of the meeting at the point of contact creates a deceptive baseline, which is heavily penalized under Georgia Administrative Code. Transparency regarding the product itself is equally critical. Producers are prohibited from failing to clearly disclose that the product being offered is, in fact, a life insurance policy rather than an investment plan, a savings vehicle, or a government-sponsored program. You must not describe the credited interest rate on a life insurance policy in a manner that implies it represents a net return on the premiums paid. Misrepresenting the mortality costs of a product by stating or implying that the policy is free or costs nothing is an explicit violation. To ensure clarity, Georgia requires that when a face-to-face solicitation occurs, you must provide the applicant with either a basic policy illustration or a written disclosure that clearly outlines the policy type, the death benefit, and the expected first-year cost. Furthermore, the state establishes strict parameters regarding how private life insurance products interact with government-provided benefits. You are legally forbidden from making any false, misleading, or deceptive representations regarding the availability, suitability, cost, limitations, or exclusions of service members' group life insurance or veterans group life insurance. You cannot imply that a private policy is superior to or an official replacement for these government-backed options without factual justification. If you are proposing a life insurance policy that contains a side fund or investment component to a service member in pay grades E4 and below, the transaction is legally presumed unsuitable unless a comprehensive needs assessment proves their existing military survivor benefits are insufficient. The mechanism of payment is another area subject to intense regulatory control. Georgia law protects service members from unauthorized financial manipulations, specifically banning producers from accessing or using a service member's electronic military pay system, commonly known as the MyPay account. You cannot input or alter allotments or routing directions within their official system to facilitate your premium payments. While you can provide the necessary insurer and premium details so the service member can execute the paperwork independently, directly managing or using their system credentials constitutes a severe compliance breach. Additionally, You cannot utilize an allotment mechanism that permits the service member to make deposits and withdrawals unrelated to the actual insurance premium payment. Finally, the state enforces specific product design mandates that prevent the unfair restriction of coverage based on military status. In specified individual life insurance products marketed to military families, insurers are prohibited from including provisions that exclude coverage for deaths resulting from or related to military service or acts of war, unless these exclusions meet highly narrow statutory exceptions. The policy must deliver true risk mitigation without hidden escape clauses for the insurer. To give military consumers adequate time to review these specialized agreements, Georgia rules ensure that policyholders can utilize standard free look periods to cancel the policy for a full refund if the terms do not align with their actual needs. See you in the next lecture. Hello, and welcome back. When we design software systems, we rely on established patterns to ensure stability and predictability, and the state of Georgia approaches life insurance sales with a similar desire for structural integrity. The rules governing life insurance solicitation exist to eliminate ambiguity and prevent asymmetric information advantages between you and the prospective policyholder. To maintain an orderly market, the state mandates that you use only authorized forms that have been vetted and approved for use. This means you cannot simply draft your own marketing material or alter a policy summary to make a product look more appealing. Every form, brochure, and disclosure statement you present during a sales interaction must be a replica of an authorized document, ensuring that the consumer receives precisely the information the state and the insurer intended them to see. This regulatory control over documentation extends well past the initial presentation or the signing of an application. Georgia law places a strict record-keeping burden directly on the producer, requiring that copies of all authorized solicitation forms be maintained within your files for a minimum of 3 years following their last official use. For example, if your agency uses a specific state-approved policy disclosure form for a product, and that specific version of the form is retired on June 1st of this year, you must keep a copy of that document accessible in your storage until June 1st 3 years from now. This creates a clear trail of compliance that state auditors can verify if a consumer files a dispute regarding what they were shown. It is your professional responsibility to establish an organized archiving system to ensure these documents are never discarded prematurely. The underlying motivation for these strict constraints is the absolute legal necessity for clear, accurate, and non-misleading information during the sales process. Insurance contracts are complex financial instruments, and a layperson cannot easily spot hidden nuances without accurate guidance. Georgia law explicitly prohibits the use of deceptive language, exaggerated claims, or omissions that could distort a consumer's understanding of what they are purchasing. If you present a policy's potential cash value accumulation without equally highlighting the fees or conditions required to achieve that growth, you have violated this standard. Your presentations must be balanced, ensuring that the consumer is not led to believe a policy possesses characteristics or guarantees that do not exist within the contract's written terms. Achieving full disclosure requires a comprehensive and honest communication of policy benefits, exclusions, and limitations. It is easy to discuss the benefits, such as a substantial death benefit or a guaranteed interest rate, but professional conduct requires you to spend equal effort on the restrictive elements of the policy. You must clearly explain what the policy does not cover, such as specific exclusion clauses or pre-existing condition limitations, alongside operational boundaries like surrender charges or waiting periods. For example, if a policy contains a 2-year suicide exclusion clause, this limitation must be transparently communicated rather than hidden in fine print. By systematically detailing both the capabilities and the boundaries of the contract, you satisfy the state-prescribed guidelines for full disclosure. Ultimately, compliance with solicitation regulations is not about checking boxes to satisfy bureaucratic whims, but about preserving the systemic integrity of the insurance industry. When a producer fails to provide an accurate representation of a policy, it erodes public trust and creates substantial legal liability for both the individual and the insurer. The state expects you to act as a qualified professional who guides consumers toward informed decisions through transparent communication and fastidious record-keeping. By committing these time frames and disclosure mandates to memory, you ensure that your sales practices align with Georgia's expectations and protect the financial well-being of the public. See you in the next lecture. Welcome back. The physical or electronic delivery of a life insurance policy is not merely an administrative afterthought, but a legally significant event that triggers specific statutory obligations under Georgia law. According to Georgia Code Section 33-24-14, an insurer must mail or deliver the policy to the insured within a reasonable period of time after its issuance, provided all premium requirements and underwriting conditions have been satisfied. This process marks the transition from an applicant to a policyholder. And as a producer, your role during this interaction is strictly bounded by consumer protection mandates. You are legally required to present the policy alongside mandatory disclosure documents, which typically include a buyer's guide and a policy summary. These disclosures must explicitly outline the exact coverage purchased, the premiums required, and the specific riders or options attached to the contract. Failing to provide these documents at or before delivery violates the state solicitation and consumer protection regulations, exposing both the producer and the insurer to severe regulatory penalties. A critical component of the delivery process is the activation of the free look period, which under Georgia law must be a minimum of 10 days for standard life insurance policies. This period grants the policy owner an unconditional right to review the contract provisions, evaluate its alignment with their financial goals, and cancel the policy for a full refund of all premiums paid. The legal clock for this 10-day window begins precisely on the date the policy is physically delivered or electronically transmitted to the policy owner, not on the date the insurer issued the contract. Because the exact timing dictates the boundary of this consumer right, the producer bears the explicit legal responsibility to accurately document the delivery date. Obtaining a signed and dated delivery receipt is the industry standard for establishing this timeline, serving as an immutable record that mitigates future contract disputes regarding whether a cancellation request fell within the lawful statutory window. When a policy is issued with modifications, or as a rated policy due to higher underwriting risks, the delivery process carries an even greater legal weight. In these scenarios, the contract issued by the insurer constitutes a counteroffer rather than an acceptance of the original application, meaning coverage is not yet in force. As a producer, you cannot simply drop off the policy. You must explain the specific rated provisions, premium adjustments, or exclusions to the applicant and secure their formal, signed acceptance of the modified terms. Furthermore, if the initial premium was not collected with the application, you're legally obligated to collect the premium during delivery while simultaneously obtaining a signed statement of continued good health. This statement legally verifies that the insured's physical condition has not deteriorated since the application was submitted, a necessary prerequisite to finalizing the contract and establishing valid consideration. See you in the next lecture. Hello, and welcome back. When a policyholder misses a life insurance premium payment, the contract does not immediately terminate. Georgia statutory law establishes a protective buffer known as the grace period, which represents a mandatory time frame during which the policy remains completely in force despite the non-payment. For standard individual life insurance policies, Georgia law dictates that this grace period must be not less than 30 days. During this window, the insurer is legally obligated to maintain the full death benefit coverage, ensuring that if the insured passes away within these 30 days, the beneficiary will still receive the policy proceeds. However, because the premium was never actually received, the insurer retains the right to deduct the overdue premium amount, along with any accrued interest from the final death benefit settlement paid out to the beneficiary. It is critical to distinguish between different types of life insurance products, as the statutory minimums for grace periods shift depending on the contract structure. While standard individual life insurance requires a minimum of 30 days, group life insurance policies governed by Georgia law must provide a grace period of not less than 31 days. Furthermore, flexible premium policies, such as universal life insurance, follow different operational rules because they do not rely on fixed calendar due dates. For these flexible contracts, the grace period begins on the specific policy processing day when the total authorized charges required to keep the policy active exceed the available cash value. In Georgia, this flexible premium grace period must extend for at least 61 days after the insurer mails a formal report to the policyholder notifying them of the insufficiency, granting consumers ample time to respond to fluctuating cash values. If the grace period expires and no payment is made, the life insurance policy officially lapses, meaning the insurance company's liability terminates and coverage ends. To remedy this scenario without forcing the consumer to purchase an entirely new contract, Georgia law mandates a reinstatement provision. This statutory right allows a policyholder to restore their lapsed life insurance policy to its original active status within 3 years from the initial date of the premium default. This timeline represents a vital consumer right, but reinstatement is never automatic and requires the policyholder to take specific, proactive legal and financial steps. The primary restriction on this right is that the policy must not have been surrendered for its cash value. Its cash value must not have been completely exhausted, and any paid-up term insurance must not have expired. To successfully execute a reinstatement under Georgia law, the insured must submit a formal written application and comply with clear financial obligations. First, the applicant must pay all back premiums that accumulated during the period of the lapse, combined with interest on those overdue premiums at a rate that cannot exceed 6% per annum, compounded annually. Additionally, if the policyholder had any outstanding policy loans or indebtedness in effect at the time the grace period expired, that debt must also be repaid or reinstated, along with interest capped at the same statutory 6% annual limit. These financial requirements ensure that the insurance company is made whole, placing the contract back into the exact financial position it would have occupied had the default never occurred. Beyond the financial restitution, the insurer has the statutory right to demand evidence of insurability before approving a reinstatement application. This means the individual cannot simply pay the back premiums if their health has drastically deteriorated since the lapse occurred. They must prove to the insurer that they still meet the company's underwriting standards. The evidence of insurability typically requires the insured to complete a health questionnaire, and depending on the time elapsed and the face amount of the policy, it may involve undergoing a new physical medical examination. Producers must emphasize to their clients that the reinstatement process protects the existing contract's original issue age and premium rates, which is why verifying insurability is a mandatory legal safeguard for the insurance company against adverse selection. Finally, there is an important statutory exception regarding the formal reinstatement application process that producers must fully understand to properly advise clients. Georgia law stipulates that if an agent or the insurance company accepts a past due premium that is more than 30 days in arrears without requiring a formal written reinstatement application, the policy is legally continued in force. In this specific scenario, the law treats the unconditional acceptance of the overdue premium as a waiver of the formal reinstatement requirements, meaning the coverage remains active without showing any official lapse of time. This rule reinforces the weight of administrative actions and underscores why insurance professionals must handle late premium payments with absolute regulatory precision to avoid inadvertently altering a client's contractual standing. See you in the next lecture. Welcome back. Today we are examining the operational and legal mechanics that govern how life insurance policies conclude, specifically focusing on how beneficiaries are designated and how claims are processed under Georgia law. For policyholder, the contract represents a promise, but for you as a producer, it represents a structured legal framework that must be navigated with technical precision. We must understand that the contract is an architecture designed to transfer wealth, and any failure in maintaining the integrity of that architecture can lead to significant regulatory and financial complications. Our role is to ensure that the policyholder's intent is clearly documented and that the insurer's obligations are met precisely as mandated by the state. The primary right of a policyholder is the ability to designate and change beneficiaries, a right that remains absolute unless an irrevocable beneficiary has been named. Under Georgia law, the policy owner retains full control over the policy, meaning they can alter the beneficiary structure at any time without the consent of a revocable beneficiary. To execute these updates accurately, the individual must possess the legal capacity to contract at the time the change is made. This means the policyholder must be of sound mind and at least 15 years of age in the state of Georgia to legally enter into or modify an insurance contract. As a producer, your administrative responsibility is to facilitate these updates by ensuring the proper forms are completed and transmitted to the insurer's home office, verifying that the policy owner's current intent matches the legal documentation on file. When a policy matures due to the death of the insured, the processing of the claim must adhere to strict statutory timelines to avoid penalties and bad faith litigation. In Georgia, insurers are legally required to pay death benefits promptly upon receiving written proof of death, which typically consists of a certified death certificate and a completed claimant form. According to Georgia Code Section 33-25-10, an individual life insurance policy must pay interest on the death proceeds if the claim is not paid within 30 days from the date of the insured's death. The interest begins to accrue from the actual date of death and must be calculated daily at the greater of 6% per annum or the insurer's highest current interest option, ensuring that beneficiaries are compensated for administrative delays. While prompt payment is mandated, the insurer also retains a clear legal obligation to investigate claims thoroughly to prevent fraud and ensure proper distribution. This investigation typically involves verifying that the policy was in force at the time of death and confirming the identity of the lawful beneficiary. If the insured dies within the 2-year contestability period, the insurer will scrutinize the original application for material misrepresentations that could invalidate the coverage. However, if the claim is approved, Georgia regulations stipulate that payment should ideally be made within 60 days of that approval. If the insurer discovers a legitimate dispute between multiple claimants, they may utilize an interpleader action, a legal proceeding where the insurer deposits the funds with a court and allows the judicial system to determine the rightful recipient, thereby releasing the insurer from liability. See you in the next lecture. Hello, and welcome back to our series on Georgia life insurance regulations. Today, we will examine the mechanisms that govern policy loans and the statutory options available when a policyholder decides to stop paying premiums. When a consumer purchases a permanent life insurance product, a portion of each premium payments allocates toward an internal accumulation known as cash value. Under Georgia insurance law, this cash value represents a non-forfeiture benefit, meaning the equity belongs strictly to the policyholder and cannot be forfeited back to the insurance carrier if the policy lapses. State statutes dictate that once a policy accumulates cash value, typically after 3 full years of premium payments, the policyholder gains a statutory right to access these funds. This access manifests either through a direct policy loan or through specific structural choices designed to preserve coverage without further funding. As insurance professionals, we must understand that a policy loan is not a traditional bank loan, but rather an advance against the eventual death benefit, secured by the cash value itself. Georgia Code Section 33-25-3.1 regulates the maximum interest rates that life insurance companies may charge on policy loans to prevent usurious lending practices within insurance products. The law allows insurers to offer policies with either a fixed maximum interest rate or an adjustable variable interest rate. If the insurer chooses to utilize a fixed rate configuration, Georgia law stipulates that the specified interest rate cannot exceed 8% per annum. This explicit ceiling protects the policyholder from escalating debt compounding against their cash accumulation. The fixed rate must be clearly outlined in the initial policy documentation so that the consumer understands the absolute upper boundary of their potential borrowing costs from day one of the contract. Alternatively, an insurer may issue a policy containing an adjustable maximum policy loan interest rate, which fluctuates based on external macroeconomic indicators. Under Georgia statute, this variable rate must be tied to a recognized index, specifically Moody's Corporate Bond Yield Average, as published by Moody's Investor Service. The insurer is required to calculate and determine the variable loan interest rate at regular intervals at least once every 12 months, but they are prohibited from altering it more frequently than once in any 3-month window. Furthermore, Georgia law protects the consumer by mandating that the rate cannot be increased unless the formula justifies an increase of at least 0.5% per annum. Conversely, the insurer must decrease the loan interest rate whenever the index drops sufficiently to warrant a reduction of 0.5% or more. Excessive borrowing can jeopardize the structural integrity of a permanent life insurance contract, creating a scenario where the outstanding loan plus accrued interest equals or exceeds the total cash value. When this threshold is breached, the policy enters a state of potential foreclosure or lapse due to non-payment of loan interest. Georgia law enforces strict consumer protection mandates regarding notification procedures before an insurer can legally terminate a contract under these conditions. The insurance carrier must send a formal written notice to the policyholder and any assignee of record at least 30 days prior to the projected date of policy expiration. This notification must be dispatched to the last known address via mail, providing a critical window for the client to make a qualifying payment and save the coverage. If a policyholder decides to discontinue premium payments entirely, they do not simply lose their built-in equity. Instead, they must select one of 3 statutory non-forfeiture options. The first option is cash surrender, where the insurer pays the accumulated net cash value directly to the owner, effectively terminating all future death benefit obligations. Under Georgia insurance regulations, the insurance company reserves the right to defer the payment of this cash surrender value for a maximum period of 6 months after the initial request. This statutory deferral window acts as a financial liquidity safeguard for insurance companies during periods of extreme macroeconomic stress or market panics. It prevents a run on the insurer's reserves, ensuring orderly asset management while guaranteeing eventual payout to the consumer. The remaining 2 non-forfeiture choices allow the client to leverage their existing cash value to maintain life insurance protection without paying any future premiums. The extended term option uses the net cash value as a single net premium to purchase term insurance with a face amount exactly equal to the original policy's death benefit. The duration of this term coverage depends strictly on how far the cash value can stretch given the insured's current age. The reduced paid-up option uses that same cash value to purchase a permanent whole life policy, but with a significantly lower face amount than the original contract. This new coverage remains active until death or maturity, continuing to grow cash value slowly over time, albeit from a smaller foundational base. Insurance producers bear an explicit ethical and legal duty to explain these complex financial components transparently during both the sales process and subsequent service interactions. Clients frequently fail to comprehend that an outstanding policy loan does not disappear. It remains an active encumbrance that directly reduces the total death benefit payable to designated beneficiaries. If an insured passes away with an outstanding balance, the insurer subtracts the loan principal and all accrued interest from the final claim check. Producers must clearly articulate that selecting an extended term or reduced paid-up option alters the original underwriting intent. Providing clear and comprehensive explanations ensures that policyholders do not inadvertently cause a policy lapse or leave their families underinsured due to a basic misunderstanding of loan mechanics. That concludes our exploration of the statutory frameworks governing policy loans and cash value protections in the state of Georgia. See you in the next lecture. Welcome back. Let's look closely at how Georgia regulates group life insurance contracts. When we evaluate group insurance from a legal standpoint, we're dealing with a distinct framework where a single master policy covers many individuals, establishing a multi-party relationship that differs fundamentally from an individual life insurance policy. In individual insurance, the contract exists directly between the insurer and the applicant, meaning underwriting focuses solely on that specific person's risk profile. Group insurance shifts this mechanism entirely by issuing the master contract to a policyholder, such as an employer, a labor union, or a professional association, while the participating individuals are provided with certificates of insurance rather than individual policies. Under Georgia law, this administrative separation creates unique legal obligations, standard provisions, and consumer rights that a producer must navigate precisely to remain fully compliant with state statutes. To establish a valid group life insurance plan in Georgia, an organization must satisfy specific statutory eligibility standards designed to prevent adverse selection, which occurs when a group is formed solely for the purpose of obtaining insurance coverage. For a standard employer-sponsored group, the law requires that the plan cover employees of the employer, and the criteria for participation must be based on conditions of employment rather than individual health status. Georgia Code dictates that a policy cannot be delivered if it is established for an artificial group, meaning the group must exist for some legitimate business purpose other than securing insurance. When we look at standard employer groups, the premium can be paid entirely by the employer under a non-contributory plan or shared with the workers under a contributory plan. If the plan is non-contributory, the administrative rule is absolute. 100% of the eligible employees in that defined class must be covered by the policy. If the plan is contributory, Georgia mandates that a minimum percentage of eligible employees, usually 75%, must elect to participate to ensure a balanced, predictable risk pool that satisfies actuarial underwriting standards. Georgia statute prescribes precise mandatory policy provisions that every group life insurance master contract must contain to protect certificate holders. One fundamental provision is the grace period, which establishes that the master policyholder is entitled to a minimum of 31 days for the payment of any premium due except the first. During this time frame, the death benefit coverage remains completely active and enforceable across the entire group, protecting individuals from losing coverage due to an employer's administrative delay. Another mandatory component is the incontestability provision, which limits the period during which an insurer can challenge the validity of the contract or statements made on an application to 2 years from the policy date. Furthermore, the misstatement of age provision operates differently in group plans than in individual ones. If an insured individual's age is found to be incorrect, the insurer does not adjust the face amount of the benefit, but instead recalculates the premium to reflect the true age, adjusting the billing sent to the master policyholder. Among the most heavily scrutinized legal protections under Georgia law is the conversion privilege, which grants certificate holders the absolute right to transition from group coverage to an individual policy without submitting evidence of insurability. This statutory right triggers when an individual's coverage under the group plan terminates due to a separation from employment, a change in job classification, or the complete termination of the master policy itself. The law provides a strict 31-day window following the termination of group coverage during which the individual must submit a written application and pay the first premium for the new individual policy. The individual policy must generally be a permanent life insurance type, such as whole life, rather than term insurance, and the premium will be calculated based on the insured attained age at the time of conversion. It is critical to recognize that if the insured person dies during this 31-day conversion period, the group death benefit must be paid by the insurer regardless of whether the individual had actually applied for the conversion policy yet. See you in the next lecture. Hello, and welcome back. To maintain a valid insurance license in the state of Georgia, you must treat your professional education as an ongoing commitment rather than a one-time event. The Georgia Office of Commissioner of Insurance and Safety Fire mandates that resident insurance producers actively complete continuing education credits within every biennial renewal cycle. If you have been licensed for less than 20 years, your specific structural requirement is 24 hours of approved continuing education every 2 years. Within those 24 hours, the state strictly enforces a sub-requirement of 3 credit hours dedicated specifically to the study of professional ethics. For experienced producers who have maintained their licensure for 20 years or more, the state adjusts the benchmark, requiring a total of 20 hours of continuing education every 2 years, though the 3-hour ethics requirement remains entirely unchanged. The operational timing of this requirement is tied directly to your individual calendar, meaning your completion deadline arrives biennially on the final day of your birth month. The state does not offer a grace period for accumulating these hours, which makes tracking your completed course credits a vital operational task. Georgia utilizes an online licensing system platform, specifically Sercon, to log and verify course credits dynamically. When an approved education provider reports your course completion, the hours are logged against your unique license number on this central portal. Relying on your own memory or paper certificates is a precarious strategy, so you should regularly review your digital transcript to guarantee that your current progress aligns perfectly with the state compliance summary before your birth month concludes. There are instances where a producer might accumulate more credits than the bare minimum required for a single renewal cycle, and the state handles this scenario with specific carryover constraints. You are legally allowed to carry forward excess continuing education hours into the subsequent 2-year renewal period, but this carryover is strictly capped at 50% of your baseline biennial requirement. This means a producer required to complete 24 hours can carry forward a maximum of 12 excess hours. However, the internal composition of these carryover hours is subject to an important restriction regarding the mandatory ethics component. While you can carry over excess hours earned in an ethics course, those hours lose their ethical classification upon entry into the next cycle and will only count as general elective credits, meaning you must still complete a brand new 3-hour ethics course in every single renewal period. Failing to meet these educational milestones before the final day of your birth month carries immediate and highly disruptive administrative consequences for your professional practice. If the deadline passes and your transcript shows a deficit, your insurance license will automatically transition into an inactive status. When your license becomes inactive, your legal authority to solicit, negotiate, or sell insurance policies within the state of Georgia is instantly revoked. Conducting any form of insurance business without an active license is a serious violation of state law that invites severe regulatory fines and disciplinary actions against your record. To return to good standing, you will be forced to undergo an administrative reinstatement process that involves completing the deficient hours, paying late renewal penalties, and submitting a signed and notarized citizenship affidavit along with secure identification. See you in the next lecture. Welcome back. Today we address the cornerstone of your professional standing in the Georgia insurance market, the ethical responsibilities of a producer. In the insurance industry, ethics are not merely a collection of abstract virtues or a set of guidelines meant to be filed away after orientation. They represent the practical framework within which you must operate to maintain your licensure and your professional integrity. At the heart of this framework is the concept of fiduciary duty, a legal and ethical obligation that requires you to act entirely in the best interest of your client. When you are sitting across from a prospective policyholder, the recommendations you make must be based strictly on their specific financial needs and protection requirements rather than the potential commission you might earn from a particular product. If you prioritize your compensation over the client's well-being, you're not just failing in ethical standard. You're actively engaging in behavior that can lead to severe regulatory scrutiny and the permanent loss of your ability to practice. It is a common misconception that being a salesperson means maximizing profit at any cost. But in the insurance world, the law explicitly demands that you put the consumer first. This alignment between law and ethics is precisely what stabilizes the market and prevents predatory sales tactics. Your goal is to guide the client to a solution that they actually need, even if that means suggesting a more affordable option that results in a lower payout for you. Honest communication is the second pillar of your ethical practice, and it functions as the primary defense against misrepresentation. You must be transparent about the terms, conditions, and limitations of the life insurance products you present. It is never acceptable to obscure the realities of a policy or to provide misleading information to secure a signature. Think about the implications of a policyholder discovering that their coverage does not function as described during a claim. This is not only an ethical failure, but a significant liability for both you and the insurer. Every statement you make during a sales pitch must be verifiable against the policy documents. When you're presenting a policy, you are effectively translating complex legal contracts into plain English, and you must do so with accuracy and completeness. If a client asks about the cash value accumulation, the death benefit, or the impact of policy loans, you are required to provide clear, factual answers that accurately reflect the contract provisions. You should never rely on vague promises or hyperbolic language to entice a client, as this will invariably damage your professional reputation and lead to disciplinary consequences under Georgia law. Avoiding conflicts of interest is essential to maintaining your role as an objective advisor. A conflict of interest arises whenever your personal interests, or those of your agency, clash with the fiduciary duties you owe your client. Perhaps the most obvious example is the practice of recommending a policy simply because it offers a higher bonus or a specific incentive that the insurer is currently promoting. While sales incentives are a standard part of corporate operations, they should never be the deciding factor in your client's financial plan. You must also be cautious regarding external relationships that could influence your advice, such as ties to specific financial products or partnerships that might cloud your professional judgment. If you find yourself in a situation where you feel pressure to recommend a specific product that does not align with your client's stated goals, you must step back and reevaluate your position. The expectation is that you will remain neutral and analytical, ensuring that every recommendation is backed by a sound assessment of the individual's risk profile and long-term financial objectives. Consider the real-world application of these principles when dealing with complex life insurance cases. Often, you will encounter situations where a client is unsure about the amount of coverage they need or the type of product that fits their budget. A professional approach involves gathering a complete picture of their financial landscape, including debt levels, family obligations, and income stability. If a client insists on a policy that is clearly inappropriate or excessive for their needs, your ethical duty is to educate them rather than simply fulfilling a request that could eventually lead to financial distress. This requires a certain level of courage, as it might involve turning down an easy sale to ensure the client is properly protected. By acting with integrity, you build the kind of trust that leads to long-term client retention and a sustainable career in this industry. Remember that state regulators in Georgia monitor these behaviors, and a history of complaints regarding questionable sales tactics will quickly lead to formal investigations and potential disciplinary action. Integrity is the defining characteristic of a successful producer, and it is the most valuable asset you have in this business. I will see you in our next session. Welcome back. In this lesson, we will focus on the professional standard for record keeping and documentation required of insurance producers by the state of Georgia. As a producer, your record-keeping practices serve as the primary evidence of your professional conduct and regulatory compliance. The Georgia Insurance Commissioner requires that you maintain accurate, legible, and easily accessible records for all insurance transactions you conduct. These records are not mere administrative burdens, but are legal protections that safeguard your license during potential audits or investigations. By maintaining an organized system, you demonstrate to the regulator that you're operating within the bounds of state law and acting in the best interest of your clients. Failing to document a transaction is functionally equivalent to not having performed that transaction from the perspective of an auditor. You must remember that when a discrepancy arises, documentation is the only authoritative source of truth. Consequently, your documentation strategy must be robust enough to withstand rigorous scrutiny under the Commissioner's oversight. The scope of mandatory documentation is broad and covers the life cycle of each policy from inception to termination. You are required to maintain detailed records regarding every contract placement, which includes the specific application forms, disclosures provided to the insured, and the finalized policy documents. Furthermore, all premium receipts must be meticulously logged, showing the date, amount received, and the specific policy or account credited. If a policy undergoes an amendment or a change in coverage, you must keep a clear trail of the request, the justification for the change, and the formal confirmation sent to the client. Equally important are client communication logs, which should chronicle significant discussions, advice provided, and any instructions received from the policyholder. Even if a conversation seems routine, documenting it protects you against future claims that you failed to provide adequate information or made misrepresentations. These records must be kept in a format that ensures data integrity and security, complying with privacy standards. Understanding the legal retention mandates is a critical aspect of staying compliant with Georgia law. While specific documents may carry unique retention windows, the general rule of thumb for a prudent producer is to maintain records for a duration that covers the statute of limitations for any potential legal or regulatory action. You should treat these records as permanent assets of your agency, ensuring they are stored in a manner that protects sensitive personal information from unauthorized access. If the insurance commissioner initiates an inquiry or a consumer files a complaint, these files serve as your defense. A disorganized or incomplete file can trigger further investigations, as regulators may interpret missing documentation as a sign of deeper noncompliance or systemic mismanagement. You should implement a standardized filing procedure that guarantees that anyone reviewing your files, whether an internal manager or an external auditor, can quickly locate, interpret, and verify the history of any given policy. Proper record keeping is fundamentally an ethical obligation you owe to your clients and the regulatory body. By tracking every interaction and financial movement, you reduce the risk of clerical errors that could otherwise lead to disciplinary actions, fines, or, in extreme cases, the revocation of your license. You must regard your documentation as a reflection of your professional integrity and your commitment to the standards set by the state of Georgia. While it may feel time-consuming to log every correspondence or verify every premium receipt, this diligence is exactly what professional licensing demands. Consistency is your best defense against the unpredictable nature of regulatory audits and consumer grievances. Always operate under the assumption that your files will be audited at some point in the future. If you establish these habits now, you will build a resilient practice that can endure the complexities of the insurance landscape. See you in the next lesson. Welcome back. Today, we're going to focus on the procedural expectations placed upon you as an insurance producer, specifically regarding the reporting mandates that keep your professional credentials in good standing with the Georgia Office of the Insurance Commissioner. As a licensed professional, you operate under a regulatory framework that requires constant transparency. The commissioner must be kept informed of your current contact information, which includes both your residence and your business addresses. Whenever you move or change your primary place of business, you are obligated to notify the department within the timeframe specified by state law. Failing to update this information is not merely a clerical oversight. It can lead to a failure in receiving essential notifications from the department, which might eventually cause your license to lapse or result in disciplinary proceedings. Keeping your data current ensures that you remain accessible for service of process and regulatory inquiries, effectively shielding you from unnecessary administrative friction. In addition to maintaining accurate contact details, you're also required to report any legal actions taken against you in other jurisdictions. This includes administrative actions, such as license suspensions, revocations, or fines imposed by insurance departments in other states. If you are convicted of a crime, regardless of the jurisdiction, you must also disclose this to the Georgia Commissioner promptly. The reasoning here is clear. The state has a vested interest in the character and professional history of those it licenses to represent insurance products to its citizens. By proactively reporting these events, you demonstrate a commitment to transparency that the department demands, rather than forcing them to uncover such information through independent background checks or third-party reports. Name changes are another area where specific protocols apply. When you legally change your name, whether due to marriage, divorce, or other personal reasons, you must submit formal notification and the required supporting documentation to the department. This process ensures that your license remains legally aligned with your identity and that your records match your other professional credentials. Each name change generally requires specific filings and, in many instances, an amendment fee. Attempting to conduct business under a name that is not officially recognized by the commissioner can create significant complications regarding commission payments and legal contracts, making it essential to handle these updates with the same rigor you would apply to a client's policy application. The authority of the insurance commissioner extends to the imposition of fines when these reporting requirements are ignored or violated. These penalties are designed to enforce compliance rather than simply to punish. They serve as a financial incentive to prioritize your regulatory obligations. The commissioner possesses the legal authority to levy fines for various infractions, including the failure to report address changes, the concealment of out-of-state disciplinary actions, or the neglect of other statutory filings. The scale of these fines is often determined by the severity of the violation and your history of noncompliance, meaning that repetitive negligence can lead to significantly escalating financial consequences that impact your professional bottom line. It is important to understand the process for appealing administrative decisions if you believe a penalty has been unfairly applied. When the department issues an order for a fine or a disciplinary action, you are generally entitled to request an administrative hearing. This is your opportunity to present your side of the matter and to provide evidence that might mitigate the findings. During this process, the burden remains on you to act in accordance with the established rules of administrative procedure, often necessitating formal submissions within strict deadlines. Engaging with the department through the proper legal channels is the only appropriate way to resolve these disputes, as attempting to bypass the official process rarely ends in a favorable result. Regulatory compliance is a fundamental aspect of your professional integrity. By treating reporting requirements with the same level of seriousness that you provide to your clients, you minimize the risk of financial loss and protect your ability to continue practicing in the state. The insurance industry relies on the mutual trust between the regulator and the licensee, and that trust is built on the foundation of consistent and accurate reporting. Remember that the Office of the Insurance Commissioner does not merely monitor your sales. They monitor your entire professional conduct, and your responsiveness to their mandates is a primary metric they use to evaluate your fitness as a producer. See you in the next lecture. Welcome back. As an insurance producer, you act as the first line of defense in maintaining the integrity of the insurance marketplace, making your role in anti-fraud compliance not just a regulatory obligation, but a fundamental professional responsibility. The state of Georgia treats insurance fraud as a severe threat to both market stability and consumer protection. When fraudulent acts occur, they drive up costs for all policyholders, effectively taxing the honest consumer to pay for the dishonesty of others. As a licensed producer, you are uniquely positioned to spot irregularities during the application process or during the handling of claims, which are the two most common areas where fraudulent activities emerge. Being vigilant is not merely a suggestion. It is a core expectation of your professional conduct, and the law provides specific frameworks to ensure these observations are acted upon effectively. The Fraud Investigation Unit within the Office of the Insurance and Safety Fire Commissioner serves as the central authority for addressing these illegal activities. This unit is specifically tasked with investigating fraudulent insurance acts perpetrated by companies, producers, or individual policyholders. Their work ensures that the insurance industry operates on a foundation of trust and that bad actors are identified and held accountable. When you encounter situations that deviate from normal business practices, you are essentially feeding critical information into this investigative apparatus, allowing the commissioner to allocate resources toward meaningful enforcement actions. Identifying fraud often requires a keen eye for subtle inconsistencies, as fraudsters rarely present themselves with obvious signs of criminality. You should be wary of applications that contain suspiciously perfect information, missing contact details, or data that contradicts verified documentation provided by the applicant. In the context of claims, watch for requests for payment to unusual parties, unexplained urgency that seems intended to bypass standard verification protocols, or documented losses that appear staged or physically impossible. These warning signs do not automatically confirm fraud, but they represent a deviation from standard patterns that requires further scrutiny or documentation to resolve the discrepancy. In the state of Georgia, if you have knowledge of or even a reasonable belief that a fraudulent insurance act is being or has been committed, you are legally mandated to report it. This reporting obligation is not discretionary. It is a statutory requirement under the Georgia Code. You must provide a formal report to the commissioner containing all pertinent information related to your suspicion or knowledge of the act. Failing to report such activities when you possess credible information can lead to disciplinary action against your own license, as regulators view such omissions as a failure to uphold your duty to the public and the industry. The law provides significant protections to those who fulfill this reporting obligation in good faith. You might worry about the potential for civil liability, such as claims of defamation or libel, if you report a client or a colleague. However, Georgia law grants immunity from civil liability to agents and insurers who report suspected fraud, provided that the report is made without malice and in the absence of fraud or bad faith on your part. This legal shield is designed to encourage transparency and prevent the fear of litigation from deterring producers from reporting the misconduct they witness in their daily professional lives. Your commitment to these protocols helps preserve the trust upon which the entire insurance model is built. When you take the time to verify information and report potential anomalies, you are protecting your own reputation by ensuring you are not inadvertently associated with illicit schemes. Furthermore, you contribute to a regulatory environment where honest competition can flourish without being undermined by those who seek to profit through deception. This collective responsibility is what keeps the insurance market accessible and affordable for the millions of consumers who rely on these products for their financial security. See you in the next lecture. Welcome back, as today we embark on a detailed exploration of the disciplinary landscape that governs insurance producers within the state of Georgia. In this session, we will examine the mechanisms, authority, and procedural safeguards that define the enforcement process. The Insurance Commissioner of Georgia holds substantial authority to regulate the conduct of licensees, which is primarily executed through the enforcement section of the department. When a producer fails to abide by the statutory requirements, the department may initiate disciplinary proceedings, which can lead to severe consequences for one's professional standing. Common grounds for such actions include, but are not limited to, the misappropriation of premiums, fraudulent misrepresentation in an application, or conviction of a felony involving moral turpitude. Furthermore, violating cease and desist orders or failing to pay child support as required by law can trigger an immediate review of a license. The commissioner possesses the authority to impose monetary penalties, suspend a license for a specific term, or permanently revoke a license altogether. These punitive measures are not merely suggestions. They're enforceable legal actions that formally enter a producer's record and influence future eligibility for licensure across various jurisdictions. When the department determines that an investigation warrants formal action, it must follow strict administrative protocols to ensure procedural fairness and due process for the licensee. The process typically begins with a notice of hearing, which outlines the specific charges leveled against the producer and cites the relevant sections of the Georgia Insurance Code that were allegedly violated. This notice acts as a formal invitation to the administrative proceeding, where the producer is granted the fundamental right to offer a defense against these claims. During this phase, it is prudent to note that the rules of evidence in administrative hearings are often more flexible than those in a traditional court of law, though they still prioritize the integrity of the regulatory record. The enforcement section bears the burden of presenting evidence that supports their findings, while the producer is entitled to be represented by legal counsel. Having experienced counsel at this juncture is invaluable because it ensures that legal arguments are properly framed and that the procedural rights afforded by the Georgia Administrative Procedure Act are fully utilized. The appeal process serves as a secondary layer of protection, allowing a licensee the ability to challenge an adverse ruling if they believe the commissioner's decision was based on flawed evidence or an incorrect application of the law. Once the commissioner issues a final order, the producer typically has a designated time frame to petition for a judicial review in a superior court. During this phase, the court will evaluate whether the department acted within its jurisdictional authority and whether the findings were supported by substantial evidence in the record. It is critical to grasp that the judicial system generally prioritizes the commissioner's expertise in insurance matters, making it quite difficult to overturn a ruling unless there is a clear instance of arbitrary behavior or a violation of due process. Consequently, most producers find that resolving disputes before the initial administrative hearing concludes is far more effective than attempting to reverse a final decision through the court system. Engaging in professional conduct is not just about avoiding punishment. It is about maintaining the professional reputation that life insurance producers rely upon for their long-term career success. A disciplinary action, especially one involving revocation or heavy fines, creates a public record that other states will see when you attempt to maintain non-resident licenses. This reciprocity means that a disciplinary event in Georgia often triggers automatic reviews and potential license consequences in every other state where you're currently authorized to transact business. Understanding these mechanics is not intended to incite fear, but rather to instill a sense of the rigorous environment in which you are expected to operate. By remaining transparent, meeting all reporting requirements, and adhering strictly to the ethical standards of the industry, you inherently minimize the risks associated with these regulatory hurdles. We must always align our business practices with the legislative intent behind our statutes, acting as stewards of the public trust. See you in the next lecture. Welcome to our final module, where we synthesize the regulatory landscape of Georgia life insurance law into a cohesive framework. We will now consolidate your understanding of commissioner authority, licensing mandates, and consumer protection protocols to ensure you can confidently navigate the state law portion of your examination. To begin our final review, we must revisit the scope of the insurance commissioner's authority within Georgia. Remember that the commissioner is an elected official empowered to enforce the state insurance code, issue cease and desist orders, and conduct investigations into suspected violations. When you encounter exam questions regarding oversight, differentiate clearly between the commissioner's administrative powers and their judicial capabilities. Administrative rules reflect the day-to-day operations of the department, while codes are the primary statutes passed by the legislature. If you're asked about the initiation of a hearing, recall that the commissioner must provide adequate notice before taking disciplinary action against a producer's license. This procedural fairness is a cornerstone of regulatory compliance, designed to safeguard the due process rights of the licensee while ensuring public interest remains protected. Next, we shift our focus to the life cycle of a producer's license, which is often a source of confusion during the testing process. Producers must adhere to strict renewal cycles, which usually occur biennially, and they must complete mandatory continuing education credits to maintain active status. If a candidate moves to Georgia from another jurisdiction, they must understand the nuances of non-resident licensing, where reciprocity agreements simplify the verification process. Always verify if the agent is operating under a temporary license, as these specific authorizations carry significant limitations regarding the types of transactions the holder can legally perform. Pay close attention to requirements surrounding address changes, as failing to notify the commissioner within the statutory period is a common regulatory lapse that can lead to unnecessary fines. Keeping your documentation organized is not just a best practice for the exam. It is a fundamental professional obligation. Unfair trade practices represent a broad category of prohibited conduct that you must categorize correctly to pass the assessment. Misrepresentation involves making false or deceptive statements regarding the terms or benefits of a policy, while twisting involves inducing a policyholder to lapse, forfeit, or surrender a policy through false comparisons. Rebating is prohibited because it offers non-disclosed incentives to entice a client to purchase insurance, which undermines the fair pricing structures mandated by law. Furthermore, coercion and intimidation are never acceptable sales tactics, as they threaten the client's autonomy in choosing their coverage. Control business is another area where you need to be precise, as using a license strictly to write insurance on oneself or close affiliates is strictly capped by statute. Understanding the distinction between these practices shows the examiner that you grasp the ethical floor upon which our industry stands. As we move into life insurance-specific mandates, keep the timeline of disclosures at the forefront of your thinking. The law requires that specific policy delivery notices be given to the insured, providing them with a clear window to review the terms and potentially exercise a free look period. Grace periods exist to protect the insured from immediate coverage lapses due to unintentional payment delays, and you should know the standard minimum duration for these periods. Reinstatement provisions are equally critical, as they allow a policyholder to restore a lapsed contract if they meet specific criteria, such as proving insurability and paying past due premiums. In group life insurance scenarios, the definitions regarding employer-employee relationships and the conversion privileges available to departing employees are strictly codified. These mechanisms ensure that the life insurance market remains stable and that beneficiaries are not unfairly deprived of their legitimate claims. Finally, we address the meta skills required to approach your exam with the necessary clarity and mental stamina. When you read a state law question, identify the subject and the specific regulatory duty being discussed before looking at the provided answers. Eliminate the distractors that focus on common industry myths rather than the strict language found within the Georgia Code. Pay special attention to qualifiers such as shall, may, or must, as these words dictate the rigidity of the regulatory requirement being tested. If you find yourself stuck, return to the core principles of consumer protection and transparency, as most regulations are written to provide clarity for the policyholder. Preparing for this final assessment is essentially about categorizing the rules you have learned and knowing when and why each specific one applies in a professional setting. Good luck with your exam preparations.